sweep and sweep again. In this short video, I'll be explaining the sweep and double sweep strategy and how to incorporate it with the tax-free cash growth warehouse. I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy and managing director of the Hawaii Financial Freethinkers Academy. Sweep strategies are utilized by many of the larger corporations worldwide, particularly in the banking and finance industry. Basically, sweep strategy consists of taking advantage of interest rate arbitrage. And that simply means that you earn a higher interest rate than you are paying for the use of a particular sum, or you might say bucket of money. For example, you deposit $1,000 in a bank savings account that pays you 1% APR. Yeah, as if you can find a bank that's paying 1% now. Anyway, let's use the 1%. The bank takes your $1,000 and puts it into an account that pays them 6%. That produces a positive 5% arbitrage for the bank. And that is actually exactly what happens when you deposit money in any bank account. The bank is using your money to make hundreds of times and even thousands of times what they pay you in interest on the money you deposit with them. Isn't that nice of them? And that's just one reason why the infinite banking tax-free cash growth warehouse strategy is such a game changer for those who put it into practice. Beyond that basic principle of arbitrage, the sweep strategy that is generally taught to individuals via the companies that specialize in teaching it promote its use for the building of wealth by means of investing in real estate for the purpose of developing multiple streams of income. There are a number of companies that teach that method, and it is a very good and profitable strategy. Those companies are also very well compensated by means of the tuitions they charge clients to teach it to them. Typically, the sweep strategy as taught by those companies use a personal line or a home equity line of credit. Those are referred to as PLOC, PLOC, personal line of credit, or HELOC, HELOC, home equity line of credit. And they're offered by most banks and credit unions. Usually those lines of credit offer an extremely low revolving interest rate for the first 1 or 2 years. And then the interest rate will increase, but still be considerably lower than most credit cards offer. For example, the lowest credit card interest rate I know of currently is at about 11.9% APR. Well, a typical PLOC, personal line of credit, will start off with an APR of around maybe 3% and then go up to maybe 8% after a couple of years. And a HELOC, home equity line of credit, will start as low as 1.5% interest. So you can see that these lines of credit offer a big advantage over credit cards and a huge advantage over amortized loans, such as car loans, mortgage loans, and personal loans. I'm not going to go into the difference between revolving and amortized interest rates here. We have another video on that you can check out on this channel. But believe me that even at 5% APR, you will pay much more in interest if it's amortized than on a revolving 8% interest for the same amount of money, or don't. Okay, so for practical purposes of the personal sweep strategy, if you have a credit card or other loan balances at the typical 11.9 to 20.9%, you can save a good deal of cash if you can get a PLOC or a HELOC and transfer that debt into that line of credit at the much lower interest rate. And that's pretty obvious. While it's not quite as convenient to use the line of credit as it is a credit card, PLOCs and HELOCs do come with checks. And that's how you use the line of credit. The way to save the maximum amount of interest is to deposit your entire income into the line of credit each time you get paid, the same as you would normally deposit your paycheck into your personal checking account, right? The reason for that is because interest is charged on the daily balance of the debt. Now, let's say you transfer a $5,000 credit card balance to your line of credit, and then you get your first check a week later in the amount of $2,500 and deposit that into the line of credit. If the line of credit is charging 3% APR, the daily percentage rate is 0.0082%. That amounts to just 41 cents per day on that $5,000 credit that you're utilizing. Times 7 days is $2.87 for a week. Then you deposit your $2,500 paycheck, reducing the balance to just $2,500. Going forward, the interest charged will be just 20.5 cents per day. Now, your rent and utilities come due for the month and you need to buy groceries, gas, whatever. So you write a check from the line of credit or just transfer the money from the line of credit into your personal checking account to cover those expenses and pay those bills. At that point, the debt balance on the line of credit goes back up and interest is again charged on the new balance per day, 0.0082%. Then you get your next paycheck, deposit it into the line of credit, the balance of the debt drops, the amount of interest charged goes down, and that's the basic sweep. See how that works, right? You take a high interest loan, transfer it or sweep it into a low interest line of credit, and then as you need the money, you sweep it back into your regular personal checking account, write checks, pay your bills, and then every time you get paid, you dump that into your line of credit instead of your checking account, and that drops the interest down. Anyway, you see how that works, right? Now you have a credit card with zero balance. So instead of transferring money to your checking account twice a month, as bills come due and groceries and gas and whatever else needs to be bought, you use that zero balance credit card to pay for all your bills all month long. And before the billing cycle ends for that credit card, you pay off the credit card balance with funds from your line of credit. So you sweep from your line of credit into the credit card to pay off the balance. Pay all of your bills with the credit card, sweep back into the credit card, pay it off. Deposit your payroll, your paychecks into your line of credit, sweep, sweep. That way, the debt balance on the line of credit is at the lowest you can make it for the whole, or at least most of the month. That way, the least possible interest is charged to the line of credit. And because you pay off the credit card before the monthly interest is charged to it, there's no interest charged to your credit card. And that's the double sweep. From there, you just repeat the cycle until the entire balance of the line of credit is paid off. Now, here's where it becomes real magic, folks. Instead of using a line of credit at the bank, once the cash value of your tax-free cash growth warehouse is to the point where you can use it to transfer other debts or just finance your monthly expenses, you use that account the exact same way as I just described using a line of credit at a bank or credit union. You see, by using your tax-free cash growth warehouse account for this sweep and double sweep strategy, you're achieving positive arbitrage on every step because your tax-free cash growth warehouse is always paying you more interest than you're being charged for your policy leverage loans. That means you're essentially never paying interest, but continuously earning interest, even as you use the money to pay your bills. Think about that for a minute. How is that not the best finance strategy ever? If you do not currently have a tax-free cash growth warehouse account, schedule a phone call with me on my Calendly calendar in the link in the description box below, or email me for a free copy of my book, Tax-Free Cash Growth Warehouse, The 178-Year-Old Secret. And of course, I highly recommend that you watch the 60-minute free webinar, also at the link below, Become Master of Your Financial World. And it describes the tax-free cash growth warehouse, why it's so valuable, and how you can get one started and how to use it. And please subscribe to this channel and post your comments here. You know, we're here to help, and we look forward to helping you soon. For now, aloha and mahalo for watching.